Two people, same year, completely different trajectories. The first is a 23-year-old who made $4 million in a single month trading cryptocurrency. He bought a Lamborghini, rented a penthouse, and started posting daily content about his system for wealth. His following exploded. Brands reached out. He was living the dream that fills social media feeds everywhere. 2 years later, he was broke. Not just back to zero, actually in debt. The crypto market shifted. His leveraged positions collapsed, and the lifestyle he'd built on a foundation of one lucky streak crumbled faster than it appeared. This story plays out constantly. The names and specifics change, but the pattern repeats across every market cycle, every trending asset class, every generation of people who mistake a lucky break for a repeatable system. Now the second person. A 47-year-old accountant in the Netherlands quietly crossing a milestone she'd been working toward for 2 decades. Her investment portfolio hit €2 million. No one threw a party. She didn't post about it. Her colleagues had no idea. She just checked her statement, smiled, and went back to work. She'd never had a viral moment, never made a single trade that anyone would call exciting, never owned anything flashy enough to photograph. She just understood something the 23-year-old didn't. Real wealth isn't built in moments of spectacular luck. It's built in decades of spectacular consistency. This is the story we rarely hear because it doesn't make good content. But it's the story of how most actual fortunes are built. Without flash, without luck, without viral success. Through mechanisms so boring they're almost invisible, yet so powerful they're almost unstoppable. Let's talk about how that actually works. First, we need to dismantle one of the most seductive lies in modern culture, that wealth comes from big breaks. The narrative is everywhere. Someone discovers the right crypto at the right moment. Someone's video goes viral and launches an empire. Someone invents something brilliant and becomes a billionaire overnight. These stories are exciting, shareable, and completely misleading as models for building wealth. Here's what the big break narrative misses. For every person who caught lightning in a bottle, there are thousands who tried the exact same thing and failed. We just don't hear about them because failure doesn't generate clicks. This is called survivorship bias. We see the winners and assume their path is reproducible, while the losers remain invisible. It's like studying lottery winners to understand financial strategy. Yes, they got rich. No, buying lottery tickets is not a wealth-building system. The person who made millions on a crypto trade wasn't executing a superior strategy. They were gambling, and they happened to win. The next 1,000 people who copy that approach will mostly lose, because gambling produces random outcomes regardless of how confidently the gambler explains their method. Real wealth builders understand this at a fundamental level. They don't chase big breaks because they recognize the math. Strategies that rely on low probability events will fail most of the time, even if they occasionally produce spectacular success stories that dominate our attention. Instead, they focus on high probability activities executed consistently over time. Boring, reliable, almost invisible, and vastly more likely to actually work. So if wealth doesn't come from luck, where does it actually come from? The answer involves 3 interlocking mechanisms that operate quietly but powerfully: compounding, ownership, and leverage. Understanding how these work, really understanding, not just nodding along, is the difference between building wealth and just hoping for it. Let's start with compounding, because it's the most important and least intuitive. Compounding is what happens when your gains generate their own gains. You invest $1,000 and earn 10%, giving you $100. Next year, you earn 10% on $1,100, giving you $110. Then 10% on $1,210. Each cycle, the base grows, which means the gains grow, which means the base grows faster. This sounds modest in year-to-year terms, but over decades, it becomes almost magical. Consider this. If you invest $10,000 once and earn 8% annually, in 10 years, you have about $22,000. Respectable. In 20 years, about $47,000. Nice. In 30 years, about $100,000. Now we're getting somewhere. In 40 years, over $217,000 from a single $10,000 investment you never added to. Now imagine you're adding to it, a few $100s a month, consistently, for decades. The numbers become life-changing, not through any single dramatic moment, but through the relentless mathematics of growth. Building on growth, building on growth. This is why time is the most valuable asset in wealth building. Not talent, not luck, not even the amount you invest. Time. Someone who starts investing modest amounts at 25 will likely end up wealthier than someone who invests larger amounts starting at 45. simply because compounding had more years to work. The catch? Compounding is boring. It's invisible for years, even decades. There's nothing to post about, nothing to celebrate, nothing that looks like success until suddenly, almost shockingly, the numbers become significant. Most people abandon the strategy before it pays off because they can't see it working. The quietly wealthy have learned to trust the math even when they can't see the results yet. They understand that compounding is a slow fuse attached to an eventual explosion of value, and their job is simply not to blow it out. The second mechanism is ownership, and this is where the gap between workers and wealth builders becomes clearest. Most people exchange time for money. They work, they get paid, they spend, they repeat. There's nothing wrong with this. It's how societies function, but it has a structural limitation. Your income is capped by your time. There are only so many hours you can work, only so much your hourly value can increase. The ceiling is built into the model. Ownership breaks through that ceiling. When you own something, a business, property, shares in companies, intellectual property, you're entitled to returns that aren't limited by your time. A rental property generates income while you sleep. Shares in a company appreciate while you're on vacation. A book you wrote 5 years ago still earns royalties today. The connection between your effort and your income becomes indirect, and that indirection is where scalability lives. This is why employees rarely become truly wealthy, while business owners often do. Not because owners work harder, but because the structure of ownership allows unlimited upside, while employment structure caps it. But here's the insight most people miss. You don't need to start a company to become an owner. You can buy ownership. When you purchase shares in a public company, you become an owner of that company. A small owner, certainly, but an owner entitled to a proportional share of its profits and growth. When you invest in an index fund, you become a fractional owner of hundreds of companies simultaneously. You didn't build those businesses, but you get to participate in their success. This is arguably the most democratized path to wealth in human history. For a few $100s, anyone can become an owner, can shift from exchanging time for money to owning assets that generate money independently of their time. The wealthy understand this and prioritize ownership acquisition above almost everything else. Every dollar not spent on consumption is a potential ownership stake in something that could grow. Every purchase is evaluated not just by what it costs, but by the ownership it prevents. That $100 dinner isn't just $100. It's the ownership stake that $100 could have become, compounding for decades. The wealthy don't necessarily skip the dinner, but they understand what they're trading when they buy it. The third mechanism is leverage, and this one requires careful handling because it cuts both ways. Leverage means using resources beyond your own to amplify results. The most common form is borrowed money. You put down a fraction of a property's price, borrow the rest, and benefit from appreciation on the entire value. If the property doubles in value, your actual return is far more than double because most of the purchase was made with someone else's money. This is how many fortunes are built. Real estate empires don't emerge from saving up to buy properties outright. They emerge from strategic use of leverage, buying one property, using its equity to finance another, building a portfolio where growth compounds across holdings that individually required minimal capital. But here's the critical caveat. Leverage amplifies losses exactly as much as it amplifies gains. The same mechanism that doubles your wealth when assets appreciate can destroy you when they decline. This is precisely what happened to the crypto trader in our opening story. He didn't just invest in volatile assets, he leveraged his investments, which means when the market dropped, his losses were multiplied. The quietly wealthy use leverage very differently than gamblers do. They use it moderately, within clear risk parameters, and primarily on assets with stable value trajectories. Borrowing to buy a rental property in an established market is leverage. Borrowing to trade derivatives is roulette with extra steps. Beyond financial leverage, there are other forms that don't involve debt at all. Hiring employees is leverage. You're using other people's time to generate value beyond what you could create alone. Building systems and processes is leverage. You're creating mechanisms that continue working without your constant involvement. Developing intellectual property is leverage. You create once, and the creation generates value repeatedly. The wealthy obsess over leverage in all its forms. They're constantly asking, how can I make my resources, money, time, knowledge, relationships work harder? How can I get outsized results relative to my inputs? How can I build systems that multiply my effort rather than just executing it directly? This isn't laziness, it's strategic architecture, and it's almost entirely invisible to anyone watching from outside. Now let's talk about why Flash fails. If compounding, ownership, and leverage are the engines of quiet wealth, Flash is the opposite. It's the appearance of wealth that actually prevents its accumulation. Flash operates on a fundamentally different logic. It's not about building value, it's about displaying value. Not about growing assets, but about depleting assets in visible ways. Not about wealth, but about wealth performance. And here's the problem. Performance is expensive. Every flashy purchase involves converting wealth into display. The luxury car, the designer items, the premium experiences, these signal success to observers, but they do so by transforming assets into consumption. Their wealth being destroyed, not built. Worse, Flash creates expectations that require ongoing spending to maintain. Once you've established a certain visible lifestyle, downgrading becomes socially costly. You're locked into spending levels not because you need them, but because you've publicly committed to them. The lifestyle becomes a trap. The people who look wealthiest are often the most financially fragile. They've optimized for appearance at the expense of substance. Their high income flows through them into consumption rather than accumulating into ownership. A job loss, a business downturn, or a market correction reveals the illusion. There's nothing behind the display except more obligations. Meanwhile, the genuinely wealthy often look ordinary. They drive reasonable cars, live in reasonable houses, wear unremarkable clothes, because they understand that every dollar spent performing wealth is a dollar that can't compound into actual wealth. The performance is not only unnecessary, it's counterproductive. This isn't about virtue or morality. It's about physics. Resources spent on display cannot simultaneously be invested for growth. You have to choose. The quietly wealthy have made their choice, and it's invisible precisely because it doesn't involve anything visible. Viral success is Flash's modern cousin, and it carries similar problems. The dream of viral success goes something like this. Create something that explodes in attention, convert that attention into money, and ride the wave to wealth. It's the ultimate big break fantasy, now democratized through social media. And occasionally, it actually works. People genuinely do build businesses on the back of viral moments. But as a strategy, as something you could reliably execute, it's almost worthless. Here's why. Virality is essentially random. Yes, there are patterns in viral content. Yes, some approaches increase your odds. But the difference between a post that reaches millions and an almost identical post that reaches dozens often comes down to factors completely outside anyone's control. Timing, algorithmic mood, what else is competing for attention that day? Building a wealth strategy around virality is like building a retirement plan around casino winnings. You might get lucky, but you probably won't, and you'll waste enormous resources trying. The deeper problem is that viral success rarely translates to lasting wealth anyway. Attention is fleeting. The person who went viral last month is mostly forgotten this month. Converting a moment of attention into durable income requires business infrastructure that most viral sensations don't have and don't build because they're too busy chasing the next viral moment. Compare this to someone building a boring business with steady customers, reliable revenue, and gradual growth. No viral moments, no explosive attention, just slow, consistent progress that compounds year after year. A decade later, the boring business is worth millions. The viral sensation had one good month and nothing to show for it. The quietly wealthy aren't hoping for virality. They're building machines, businesses, portfolios, assets that generate value reliably, regardless of whether anyone's paying attention. Let's talk about what systems-driven wealth actually looks like in practice, because the concept can feel abstract. A system is a repeatable process that produces consistent outcomes. When applied to wealth, it means creating mechanisms that generate money with decreasing personal effort over time. Consider someone who builds a small software tool that solves a specific problem, say a plugin that automates a tedious task for a particular profession. They spend 6 months building it, launch it for a modest monthly fee, and it slowly gains users. There's no viral moment, no big break, just gradual adoption from people who find it useful. After 2 years, the tool has 1,000 users paying $15 monthly. That's $15,000 every month, mostly while the creator focuses on other things. Now they build another tool. Same process, another income stream, then another. Each one required effort to create, but now runs mostly autonomously. 5 years later, They're generating more in passive income than most people earn at their jobs, from assets they built once. This is systems thinking applied to wealth. Instead of trading time for money indefinitely, you invest time building things that generate money independently. The upfront work is often harder than a regular job, but the long-term math is completely different. The same principle applies to investing. A systematic investor doesn't try to time the market or pick winning stocks. They set up automatic contributions to diversified funds, reinvest dividends automatically, and rebalance periodically according to predetermined rules. The system runs without emotional decision-making, without monitoring, without effort, and over decades, it builds significant wealth. Contrast this with someone who checks their stocks daily, makes frequent trades based on news and hunches, and feels stressed about every market movement. They're working harder and almost certainly getting worse results, because human judgment, applied frequently, tends to underperform simple systems executed consistently. The wealthy build systems. The would-be wealthy work harder while hoping for breaks. The systems win. Now let's address the timeline problem, because this is where most people's wealth-building ambitions die. Everything we've discussed, compounding, ownership, leverage, systems, operates on timescales that feel almost incomprehensible in our instant gratification culture. Compounding takes decades to become dramatic. Building ownership stakes takes years of consistent investment. Creating systems requires sustained effort before they generate returns. The strategies that actually work don't produce visible results in months or even years. They produce visible results in decades. This creates a painful mismatch between what works and what feels like it's working. The person chasing viral success gets immediate feedback, views, likes, comments. Even if it doesn't convert to wealth, the numbers feel like progress. The person systematically investing gets nothing except quarterly statements showing modest changes. After a year of smart wealth building, they might have almost nothing to show for it visibly. This is exactly why most people abandon effective strategies for ineffective ones. The effective strategies feel like they're failing because there's no short-term feedback. The ineffective strategies feel like progress because there's constant activity and occasional small wins. The quietly wealthy have somehow solved this psychological challenge. They've developed the capacity to execute long-term strategies without requiring short-term validation. They trust the math even when their bank account doesn't yet reflect it. They understand that the feeling of progress and actual progress are entirely different things. How do they do this? Often through financial education, truly understanding how compounding works, running the numbers themselves, seeing mathematical proof of future outcomes, often through automating contributions so the decision doesn't have to be made repeatedly, often through finding communities of like-minded people who reinforce the long view. Whatever their method, they found a way to maintain consistent action across timescales that break most people's resolve. Here's another crucial insight. The wealthy optimize differently than the average person. Most people optimize for income, the amount of money coming in. This makes sense intuitively. More income means more money, right? But the wealthy optimize for something different, the gap between income and spending. Because that gap, not the income itself, is what can be converted into ownership and compounding. Someone earning $300,000 while spending $290,000 builds wealth slower than someone earning $80,000 while spending $50,000. The first person has $10,000 annually to invest. The second has $30,000. Despite earning almost 4 times less, the second person accumulates wealth 3 times faster. This is why lifestyle inflation, increasing spending as income rises, is so destructive to wealth building. Every dollar of lifestyle inflation is a dollar that could have entered the compounding engine, but instead was consumed. The promotion and raise that felt like progress actually changed nothing if spending rose to match it. The wealthy are relentlessly focused on this gap. They're not necessarily frugal in a miserly way. Many spend freely on things they value, but they're intensely aware of the gap and protect it deliberately. When income rises, they increase their investment rate before increasing their spending. The gap grows with their income instead of staying constant or shrinking. This optimization also applies to time. Most people optimize for income per hour, getting paid more for their time. The wealthy optimize for wealth per hour, building assets and systems that generate returns disproportionate to time invested. Writing a book takes perhaps 1,000 hours. If it generates $10 in royalties annually for 20 years, that's $200,000. or $200 per hour invested. Building a software system might take similar time, but generate ongoing subscription revenue that compounds. The hourly income from a traditional job might be higher in the short term, but the wealth per hour from asset creation can be dramatically higher over time. This different optimization explains different behaviors. The wealthy person who spends a year building something with no immediate income isn't failing. They're optimizing for a different variable. The person working overtime for extra hourly pay isn't succeeding. They're optimizing for something that has hard limits. Let's talk about risk, because it's widely misunderstood in the context of wealth building. The common perception is that getting rich requires taking big risks, betting big, risking it all, swinging for the fences. The stories we hear about wealth tend to emphasize dramatic risks that paid off. The reality is more nuanced. The wealthy take calculated risks, but they're obsessive about not taking catastrophic ones. A calculated risk is one where the potential upside justifies the potential downside, and the downside won't destroy you. Investing in a diversified portfolio involves risk. Markets can decline, but the risk is manageable. Starting a business while maintaining savings involves risk, but failure won't leave you homeless. A catastrophic risk is one where a bad outcome eliminates your ability to continue playing. Putting your entire net worth into a single speculative asset is catastrophic risk. If it fails, you're starting over from zero. Using maximum leverage on volatile investments is catastrophic risk. Risking money you can't afford to lose is catastrophic risk. The distinction matters because wealth building is a long game, and the only way to lose permanently is to be forced out of the game entirely. As long as you're still playing, still investing, still building, still compounding, temporary setbacks are just that, temporary. But a catastrophic loss ends your participation. This is why the wealthy are often surprisingly conservative in their core holdings. They might take calculated risks with a portion of their portfolio, venture investments, speculative positions, new business ventures, but these sit on top of a stable foundation that protects against catastrophe. They never risk the farm. They never put themselves in a position where one bad outcome means game over. The gamblers who occasionally win big take catastrophic risks, which is exactly why they also occasionally lose everything. The quietly wealthy have found ways to participate in upside without exposing themselves to total ruin. Finally, let's address what might be the most counterintuitive insight of all. The wealthy often care less about money than people struggling to build wealth. This seems backward. Shouldn't people who successfully build wealth be the ones most obsessed with it? But think about what obsession with money actually looks like. Anxiety about not having enough, constant comparison to others who have more, emotional decision-making driven by fear and greed, short-term thinking motivated by desperation. None of these lead to good wealth-building decisions. They lead to panic selling during downturns, to chasing whatever seems hot right now, to taking catastrophic risks, hoping for quick solutions, to spending on status items to feel better about perceived inadequacy. The quietly wealthy have achieved a different relationship with money. They see it as a tool, useful, worth managing intelligently, but not a source of identity or emotional security. This detachment allows them to make rational decisions, buying when others panic, selling when others are greedy, ignoring what's trendy, focusing on fundamentals. It's paradoxical but consistent. The less emotional your relationship with money, the better your financial outcomes tend to be. The people most desperate to get rich often make decisions that guarantee they won't. The people who approach wealth calmly, systemically, and patiently tend to actually build it. This doesn't mean the wealthy don't enjoy money or work hard to build it. They do. But they've somehow decoupled their emotional state from their bank balance, which lets them play the long game without constant anxiety disrupting their judgment. So where does this leave us? Wealth isn't built through flash. Flash is a tax on wealth, paid in exchange for temporary status. Wealth isn't built through luck. Luck is random, and strategies dependent on randomness fail most of the time. Wealth isn't built through viral success. Attention is fleeting and rarely converts to durable value. Wealth is built through compounding, gains generating gains, year after year, until the numbers become significant. Through ownership, acquiring assets that generate returns independent of your time. Through leverage, making resources work harder than they otherwise would. Through systems, creating mechanisms that produce value without constant effort. These mechanisms are boring, they're invisible, They operate on timescales that feel endless while you're living through them. But they work. Not occasionally, not if you're lucky, not if you find the right opportunity. They work reliably for almost anyone who executes them consistently. The 23-year-old who made millions and lost them didn't fail because of bad luck. He failed because his wealth was never real. It was a temporary fluctuation that he mistook for a permanent condition. The accountant who quietly accumulated millions didn't succeed because she was lucky. She succeeded because she understood something about how wealth actually works and executed accordingly without anyone noticing or caring. That's the choice, ultimately. The exciting path that usually fails, or the boring path that usually works. The flashy approach that feels like progress, or the quiet approach that is progress. The wealth is built the same way every time. Without flash, without luck, without viral success. Just systems, strategy, and time. If this shifted how you think about building wealth, consider subscribing. We explore the mechanics behind money, systems, and strategy. The things that actually work, even when they don't make good content. Next time, we'll look at another principle that separates those who build lasting wealth from those who just look like they have.